Hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Today we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. Hello, Chad Frantzen here. Welcome to the Kingdom Finance Show. Today, we're going to be talking about what is going on with the banks. Unless you've been living under a rock for the last month or so, there's been a lot in the news, both in the United States and internationally, about the banking system. And specifically, this kicked off on March 10th when regulators closed Silicon Valley Bank, SVB, as depositors rushed for the gates, pulling tens of billions of dollars out of the bank. As it turns out, there were some other banks. Signature Bank was closed 2 days later, and in Europe, Swiss regulators had to broker a purchase of Credit Suisse Bank by UBS. So a lot has been going on in the banking world, and we've had a lot of our clients reach out to us. Hey, Chad, what is going on with the banking system? Is the dollar going to default, or are we going to a completely digital currency? What does this mean? Are we going to have another 2008? With the current banking system. So I wanted to share today some thoughts on that. Primarily, I want to focus on not so much the intricacies of what happened with the mismanagement at SVB, which we could talk a lot about, them focusing more on liberal agendas versus prudent risk management, as most banks do. And typically bankers are very wise about this, but there definitely was some mismanagement there. But I really want to focus today on what can you as listeners, as fellow Americans, fellow taxpayers, hardworking people, what can we do in response to this? Now, of course, in a recent letter that just came out, the annual shareholder letter from JP Morgan's CEO, Jamie Dimon, who's one of the preeminent thought leaders in the financial services industry, highly thought of. He would be up there with the likes of Warren Buffett and others when it comes to thinking through banking regulations, thinking through how do we stress test banks and so forth. So I'm always curious when some of these thought leaders and CEOs, when they come out with public comments. Obviously, we want to kind of glean from it what we can. We want to get the meat off the bone and spit out the bone. I don't agree with everything that comes out from some of these leaders, but it was interesting. Some comments made this week from Jamie Dimon, really telling for how banks are and what he said. Now, Jamie Dimon's a longtime CEO of JP Morgan Chase, one of the largest banks in the world. And he did say that this current banking crisis is not yet over. And even when it is behind us, that there will be repercussions from it for years to come. And that's a direct quote. He goes on to say that the risks are abundant, and managing these risks will require constant and vigilant scrutiny as the world evolves. So a less than glowing endorsement from one of the leading bankers in the world on the current regulatory system and what happened with SVB and Republic Bank, First Republic Bank and Signature Bank as well. First Republic Bank, JP Morgan, and some other large banks actually had to pull together about $30 billion in order to avoid that bank from collapsing and possibly becoming the next SVB. So all this stress on regional banks, a couple things have happened. People have withdrawn billions of dollars out of regional banks and put them where? Not under their mattress, and maybe some in gold and silver, but they've put the money into the too big to fail banks. So the rich get richer, the big get bigger, in Wall Street and corporate America when things like this happen. So deposits for JP Morgan Chase, Wells Fargo, Bank of America have gone up significantly as a result of this regional banking collapse on that. So that, in our opinion, is not a good thing. I'm gonna share why I believe that is so, and what are some steps you, as savvy investors, as kingdom-minded investors, what you can do right now with your resources on that. So let's talk a little bit about how exactly do banks work. Right. So, I mean, if even when we were in grade school, you learned about, you have the bank and you go down there and you take your cash, or you go write a check to deposit money. You go to the ATM. Well, banks, at a very simplistic level, they take in deposits, which are your money, your hard-earned money. And when that money is deposited, it technically becomes a liability to the bank. Now, stay with me here, because the bank now must take this money and they must invest it wisely so that the proceeds from how they invest the money, now that's your money, how it can be earned to where they make money as the bank, and then they pay you out a portion of that in the form of interest and dividends. Now, when done prudently, with proper risk management and portfolio management, banks can make significant, quite significant sums of money on your money. And in fact, they make a much higher rate of return. They take on a little more risk. They invest that money, and they return to you some form of a much more meager return in the form of interest and dividends. Banks will typically, and I'm just talking at a high level here, banks will typically invest in things such as mortgage securities and U.S. government treasuries. Now, although these types of investments are regarded as fairly safe investments, when they're not managed properly, they do pose a couple of major risks, which is what came about last month to the forefront with SVB and Signature Bank, that being interest rate risk and liquidity risk. Now, one of the common fallacies in investing is that, well, Chad, if I just invest my money in bonds, I will never lose. And that is just completely an incorrect statement. Now, certainly bonds as a whole are a lower volatile, more conservative investment than investing in small cap stocks or large cap stocks. However, they are not necessarily a risk-free investment where you are guaranteed not to lose your money. Now, what did happen with SVB is they were bailed out not only by the FDIC, which is I'm going to talk about that in a minute, but also by the U.S. Treasury to ensure everyone was made whole on that. But let's get back to how banks work, and this is important to know because when you are saving, when you're investing, when you're trying to make plans to create generational wealth, when you're trying to make plans for retirement and college savings, and you want to understand how these banks work. And so what obviously happened at SVB was some pretty egregious mismanagement, but also just how the banking system is set up. It's really set up for Wall Street and corporate America to make significant sums of money while the average investor just kind of muddles through. Now, that's my opinion. But I do think a lot of people share that observation with how the banking system is set up. Now, let's talk about these regulatory agencies. The FDIC, Federal Deposit Insurance Corporation, is an independent agency. It's created by Congress with the goal is to maintain stability and, catch this, public confidence in the nation's financial system. And there's also a sister organization called the SIPC, which is created to do the same thing for investment brokerage firms. So they insure deposits, they examine and supervise financial institutions for safety, And they also manage receivership. So SVB goes bankrupt. FDIC is stepping in, and we've since learned that those assets and deposits have been acquired by First Citizens Bank, another bank here in the United States. So it's really important to know when you have cash, money, savings at a bank or a brokerage firm, what these FDIC and SIPC regulations and limits are. So let me give you a couple of examples here. If you have $200,000 in a savings account, and then you have $100,000 in a CD, so that's a total of $300,000. Only $250,000 of the $300,000 is insured. So you actually have $50,000 that is uninsured. Now, I just give those numbers as a basic example. So clearly, if you have under $250,000, you're good. That money is going to be insured against a run on the bank, against the bank going bankrupt or becoming insolvent. Now, for those of you who have more than $250,000 in banks and institutions, this is the area where we have to be very mindful that anything above that, based on the account registration, is going to be uninsured. Now, there are some ways to plan around that legally to make sure you get full protection, but if you do no other planning, in that example, some of that money is going to be uninsured. Now, in a second example, we have a husband and wife. They have $500,000 in a joint account at a bank, and then they also have a retirement account, let's say an IRA of some type, and it has another couple $100,000 in that. In that scenario, the entire amount is going to be covered by FDIC insurance because each husband and wife are covered for $250,000 of protection. And then the retirement account is considered a different account category. So that too will be covered up to the $250,000 limit. Now, I may have confused some of you with those examples, but the key point here is you really want to understand the fine print when it comes to, well, how much of my money is going to be federally insured and protected on that. So what are investors doing in light of kind of this run on the bank? And it's been a few weeks. There's still some nerves out there. I shared with you some comments made by Jamie Dimon of JP Chase that there's still more pain to come. You know, many investors are turning back to crypto, things like Bitcoin and Ethereum. We're seeing a lot of people turn to just put their money with the big banks, right? As I mentioned earlier, really turning away from regional banks, local banks, and just putting their money with the too big to fail Bank of America's, JP Morgan's, and Wells Fargo's of the world. And then there's also investors who are rightfully savvy that are taking some of their cash, and they're just buying more precious metals. They're buying things like gold and silver and platinum. Now all of these responses have their validity. I wouldn't judge any of them as being incorrect. I think when we talk about financial decision making, financial investing, we have to think about behavior. And there's a whole concept on behavioral finance, which we could do a show on. But really, this is it is emotions, it is feelings, it is the continuum, if you will, from greed to fear. And so what I want to encourage you is that we're not called to live with a spirit of fear, right? We're called to live with faith, with a clear mind, and knowing that God works for the good in all things. Now, that does not mean that we don't stay in tune with what's going on in the economy, what's going on at banks, what's going on geopolitically speaking, to where we make wise choices with that. However, those are all three responses that we've seen over the last 30 days from this banking crisis. I do think there are some some issues with banks. And if you've listened to us on some of our other Wealth Builders Investments webinars and workshops and podcasts, we've mentioned this concept that historically, when the Federal Reserve is raising interest rates, when it's a rising interest rate environment, what happens historically is that the Federal Reserve, now that's the central bank of the United States, they will raise interest rates until they break something. And I've been saying that for at least since last summer, early last fall. And that's exactly what we're starting to see happening with this regional banking crisis is some things start to break. When you raise interest rates as aggressively as the Federal Reserve has done, and you have inflation that's being as stubborn as it is, inevitably something will break. So we think that will continue. Obviously, we're watching the job market and the growth of the economy and corporate earnings very closely. Those are other things that will be impacted by higher interest rates on that. Well, let's talk about in response to what investors have done over the last 30 days. I want to take you through two other categories for today's show. One, I want to really define what risk is and how do we define it as investors. And then I want to share with you what I think is a better way for how do you manage risk, how do you manage your money in light of the current environment of what you've been reading about in the news. So when we talk about risk, there's several categories for this. And so the one type of risk is just, well, what type of assets is your money in? Now, let's be clear. Cash is an asset. Real estate is an asset. Gold and silver, oil and gas, stocks and bonds, right? These are all types of assets. And again, I'm not giving recommendations here, merely talking at a high level. Risk can be defined as, well, what types of assets do I have my money in? If you have all your money in cash or CDs or money market, that's kind of all one category of cash or cash alternatives. There's risk associated with that, such as interest rate risk or inflation risk. If you have all your money in small cap stocks or large cap stocks, there's a certain type of risk associated with that. Now, the second type of risk is what I'm going to call entity risk or manager risk. And so in this scenario, if you have all your money at JP Morgan Chase, or if you have all your money at Bank of America Merrill Lynch, then you have a form of entity risk. Now, it's very unlikely that either of those firms are ever going to go bankrupt or become insolvent. But, stranger things have happened. We had 2008 with Bear Stearns and Lehman Brothers and quite the financial shakeup then, AIG, just to name a few. But entity risk is just saying you have all your money with one institution and their policies, their procedures, the decisions made by their board and CEO, the investment decisions they make, the policies on culture that they make. You are affected directly by that. And if you have all your eggs in one basket at one entity, so to speak, that creates a level of risk. Two other forms of risk, which I've mentioned already. One is called liquidity risk. So if you think of money as steps on a ladder, if you had a ladder and you leaned it up against the side of your house, each step on the ladder from lowest to highest is a different place where you can put some of your money. Now, liquidity is really like having your money on the ground. It's not even on the first step. It doesn't earn that much interest, but you can have it. It might even be under your mattress, right? I mean, this is money that you can get to it in a minute's notice. It's not going to earn as much. So as you go up each step of the ladder, you have the potential to earn higher rates of interest on your money as you commit your money to a longer holding time. So if you think of some money halfway up that ladder, it's going to earn a higher rate of return than the money that's on the first step or on the ground, but it's also money that you need to commit for a certain time period. And let's call that 1 to 2 years. Conversely, if you have money at the top of the ladder, at the very, very top couple of steps, that is money that is really long-term money. It is not liquid. So you have a measure of liquidity risk with that money up there at the top. However, there is the potential for meaningfully higher rates of return and interest on that money that's at the higher steps on the ladder. I hope that's a good visual. I use that in some of my teaching. So liquidity risk is real, but it just needs to be managed from low, medium to high. And then another type of risk is inflation. And I know many of you listening are aware of that now. Even my children who buy Legos and Frozen toys are aware that the rising cost of toys has to be attributed to inflation. And it's a very real thing. So purchasing power, right? If you're buying groceries, if you're going out to eat, if you're buying things at any of your normal shopping places, these things are costing more to produce. They're costing more for us as consumers. That is inflation at its finest. And so when you are managing resources, you need to be aware that you need to combat inflation. And the best way you do that is by making informed decisions on, well, how do I allocate my investment portfolio? All right. Well, let me throw out a new measure of risk. Many of you that follow the Kingdom Finance Show and Wealth Builders Investments are aware that we do take a kingdom worldview perspective on investing. And so we call that biblically responsible or pro-values investing. So another measure of risk, again, we're talking about where you keep your money at banks and financial institutions. And we're talking about today on this show, well, what's wrong with banks? What's been happening on them? Why has there been on the run on the banks? Is there more pain to come? We think there potentially is, especially given some comments that have come out in the last week or so by some key thought leaders in the banking industry. But another measure of risk is how exposed are you based on where you bank and what financial institutions you work with to the liberal agenda and the support of what I'm going to call woke culture. Many of the big banks, many of the big tech companies, many of the Fortune 500 companies are very supportive of liberal socialism agendas. They're very supportive of movements and thinking that are in direct opposition to a biblical worldview, and some of which are even outright attacking Christianity. And so if you share the worldview that we have of we are followers of Jesus Christ, we do need to have a kingdom worldview on how to serve others, but also how to be good stewards of what God has given us. This new measure of risk is if you have all your money in one of these big banks, that their policies are very liberal. They're very much against freedom of religion, freedom of speech, First and Second Amendment rights. Then that's a whole nother level of risk that I can't say that we talked about 5 to 10 years ago, but I think it's one to be aware of. We have a lot of people coming to us who say, hey, I don't want to have my money connected with those type of banks and financial institutions because I know that they support things that are completely against my biblical worldview and my faith. So I hope that's helpful. I wanted to define risk in those categories. Again, we have this exposure to the liberal agenda, inflation, liquidity, entity risk, and then what type of assets you are in. There's several others, but I thought those would be most appropriate for today's show to cover with everyone. Well, let me kind of, as we wrap up today's show on what's wrong with banks, again, I want to give you a strategy, and then I'm going to offer you, I've got a free download you can go online to get here at the end of the show, I want to share with you some suggestions in light of the current environment of where we are with the dollar and with what's going on with China, what interest rate policies are, where the stock market is. I want to just run through a handful of suggestions for you all. Again, these are high-level suggestions. Again, I encourage you. You're going to want to talk one-on-one with your financial advisor, financial planner on how does this fit your personal situation. And again, if you want to learn more about the services we offer, we're happy to visit with you one-on-one. Again, you can find us at wealthbuilders.net, wealthbuilders.net, and I'll give you the download link here in just a few minutes. So let's talk about, well, what's an appropriate approach for someone who wants to be kingdom-minded and very thoughtful on how we manage our money in light of some of these topics with the big banks and the regional banks and what's happening. First of all, I believe you need to diversify your cash across multiple institutions. Now, one of the things we do at Wealth Builders Investments, we are an independent registered investment advisor, is we work with families to help them diversify their money across multiple financial institutions. We tend to avoid the big banks that have liberal agenda, and we attempt to ensure that clients are well diversified and not isolated in just one institution. The second point would be I would really advocate that you look at your risk profile as an investor and really pray about, do research on being invested in asset classes besides just stocks and bonds. And I would even say besides just stocks, bonds, and gold. I would say there's probably 6 to 8 strong asset classes that a well-rounded investor will invest in. And one concept that Wall Street talks a lot about, but I don't think does a good job of implementing, is what we call correlation. So correlation is just a technical term that means, hey, I may have a 50-page statement of investments in my IRA, but I think it's diversified. But when I really look down into it, down in the weeds, actually everything for the most part goes up at the same time, or everything goes horribly down at the same time. And so correlation just means, how do two factors, let's say X and Y, how do they relate to one another? So when X goes up, maybe Y doesn't, or when Y goes up, X doesn't. And so non-correlation is really important when we have economic shakings and we have geopolitical events going on. You need to have your dollars, your assets invested in 6 to 8 different types of categories with a meaningful level of non-correlation. So if I'm going to tell you how you can find out, hey, Chad, is what I'm doing now, is it have a good level of correlation or a bad? We're happy to kind of help you understand that. But that's a key concept. Just because you invest in 20 different stocks or 20 different pieces of real estate doesn't mean that you're fully diversified and that you have a non-correlated portfolio. All right, number three. Number three is, when you're looking at managing risk and managing your money, we want you to focus on passive income streams. So we want to look for assets that can create cash flow. Now, we love investing in gold and silver and precious metals, but remember, they don't pay a dividend, but they are really good stores of value for your money. So I always encourage folks, you want to create a well-rounded portfolio that has different types of assets, some that are hard assets, some that are paper assets, and some, and I would say a good amount, that have some stream of passive income component to it. We talk a lot about that in some of our other episodes and some of our other programs. But again, we want things that have a return on asset in the form of a cash flow, a dividend, or rental income, things like that. Point number 4, really want to encourage people in light of the economic environment, what's happening with banks, is you need to manage wisely the percentage that you have in traditional stock market investments. And whether that's mutual funds or index funds or ETFs, individual stocks, you really need to be mindful, because the adage that just buy and hold and ride the wave, everything's going to be okay. It's more a strategy of hope and not a strategy of wise management. And so a lot of people that I meet that reach out to us, they have significantly more exposure into volatile stock market investments than what they thought they did. Now, I invest in the stock market. I think if you know what you're doing and you're properly diversified, I think it is a good long-term asset to invest in. But many people unknowingly are invested in way too aggressive stocks and mutual funds. They're getting charged way too much in fees. And to go back to another measure of risk, they're investing in companies that are some of the chief supporters of the liberal and woke agenda. We have this chart that we use in some of our workshops, and if your investment account were to go down 30% in a bear market, in a recession, you would have to earn significantly more than 30% in order to get back to even. So I don't have the chart in front of me here today, but if you lost 30% because of the law of compounding, you're going to have to earn 47 to 50% to get you back to where you were. And in order to do that, you're probably going to have to take more risk than what you would be comfortable with. And that is the pitfall that many everyday investors fall into, is they ride the proverbial wave because the big bank or the big financial brokerage firm said, hey, don't worry about it, we've got it under control. And when these major economic shakings happen, you're kind of left holding the bag. Well, I hope that's been helpful to give you, really define what's the response to what's been happening in the banks? What are some measures of risk? And what are some things you can be doing as everyday investors who want to make wise decisions with your money? Again, our main approach with what we do is we want to take an approach of making sense of making money from making a difference. And we want to be mindful of not investing alongside the liberal agendas. And we want to be mindful of not just putting all of our monies in one particular bank or brokerage firm. So one of the things we do, I'm going to wrap up here at Wealth Builders Investments, is we help families do everything I've talked about as far as all the suggestions I made. If that's of interest to you, please reach out to us. We can help you make sure your money is properly diversified, that you're in the right types of asset classes. Now, again, everyone's different, so that's why you really need to reach out and have a complimentary consultation with us, or talk to your local advisor if you're already working with someone. I want to encourage you not to be utilizing a lot of these super liberal banks and institutions. I think there's a better way for that, because it's just not in alignment with our biblical values. And we have to start making conscious decisions, not only on how we vote and how we shop, but specifically on how we invest. Because remember, investing is a form of ownership, and that's different in the Lord's eyes. One of the things, if you go to wealthbuilders.net/invest, that's wealthbuilders.net/invest, we've got a free resource for you there that you can download. And also, as part of getting that free resource, we are offering a complimentary X-ray of your investment assets. So think of this X-ray as a stress test to show you how much of your dollars are uninsured if it's at a bank, right? We talked about FDIC and SIPC earlier. We'll also give you feedback on how much exposure you have to companies that violate biblically responsible ethics and support the liberal agenda. And we'll also, in this X-ray, give you feedback on how much correlation you have with your investments. So just wanted to make this really practical today with the things I'm talking about. And if you're like, well, I'd really like to know how well would my portfolio hold up if the market goes down 20%, how exposed am I to left-leaning companies that do not promote my faith values? And how diversified am I? I'm in a lot of stocks and mutual funds, but am I truly non-correlated with what I'm doing? So again, I hope you've enjoyed this. Again, a lot going on in the markets and the economy. We appreciate you joining us here on the Kingdom Finance Show. So if you want to get the free X-ray risk assessment, so you can know based on what we shared today, how that lines up with you personally, go to wealthbuilders.net/invest. We've got a free download for you there, which we think you're going to love. And then as a follow-up to that, we can provide you a complimentary financial X-ray based on the points we talked about today. Well, hey, thanks so much again for being here on the Kingdom Finance Show, and we wish you the best, and we will see you next time. Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show.